Jaguar Mining and Aura Minerals serve as quintessential examples of two distinct corporate philosophies, one focused on the technical rehabilitation and optimization of a high-grade regional stronghold, and the other on a multi-jurisdictional, growth-oriented aggregator model. This report provides a comparative analysis of these two entities, evaluating their operational performance, financial robustness, valuation metrics, and the multifaceted risk profiles that define their investment potential in the current fiscal year. The fundamental distinction between Jaguar Mining and Aura Minerals is rooted in their geographic focus and growth mechanics. Jaguar Mining is a dedicated specialist in Brazil's Iron Quadrangle, a region synonymous with high-grade greenstone belt gold mineralization. Its strategy is characterized by a multi-stage resumption plan for its suspended assets and a coiled spring recovery narrative following geotechnical setbacks in late 2024. Conversely, Aura Minerals has adopted a Pan-America's aggregator model, diversifying across Brazil, Mexico, Honduras, and Guatemala. Aura's 360-degree mining philosophy emphasizes rapid scaling through greenfield development and opportunistic M&A, aiming to exceed 600,000 gold-equivalent ounces in annual production.
Key operational differences. Jaguar Mining operates primarily in the Iron Quadrangle of Brazil with 3 mining complexes. Its strategic focus remains on asset turnarounds and restarts. In 2025, the company produced 40,254 gold ounces. The primary catalysts for 2026 include the restart of the Turmalina and Santa Isabel lines. Aura Minerals maintains a diversified portfolio across the Pan-Americas, with 6 operating mines and 4 development projects. Its strategic focus is on rapid-scale expansion and M&A. In 2025, it produced 280,414 GEO. Key catalysts include the continued ramp-up of the Borborema mine and the construction of Era Dorada. Jaguar Mining, the turnaround and optimization thesis. Jaguar Mining entered 2025 under significant operational duress following the temporary suspension of the Turmalina mine. This suspension resulted from a localized slump at the Satanoco dry stacked facility in December 2024, involving approximately 600,000 cubic meters of material and extending nearly 330 meters. The incident forced a reliance on the pillar mine to sustain consolidated output for the year. The rehabilitation of the MTL complex, which includes the Turmalina mine and processing plant, is the central pillar of Jaguar's 2026 outlook. The company's response was a methodical, 5-stage resumption plan designed to meet the requirements of the National Mining Agency and environmental authorities. As of January 2026, progress has reached the following milestones.
Stage 1. Temporary surface support infrastructure, including facilities like a canteen and warehouse, was completed in September 2025. Stage 2. Underground emergency paths and ventilation chimney upgrades were finalized in November 2025. Stage 3. The resumption of productive underground development was authorized by the A&M in January 2026. Stage 4. The resumption of full underground mining was authorized in January 2026. Stage 5. The operational resumption of the surface metallurgical plant was authorized in January 2026. A critical component of this restart is the new tailings disposal area within the Fina open pit, providing capacity for at least 2 years. Geotechnical work on the southeastern slope in September 2025 achieved a safety factor exceeding 1.5, ensuring long-term stability. While Turmalina was offline, the Pillar mine served as the sole producing asset. For the full year 2025, Pillar produced 40,012 ounces of gold from 370,253 tons milled, at an average head grade of 3.77 grams per ton and an 89% recovery rate. During the Turmalina suspension, Jaguar reallocated technical expertise and equipment to Pillar, supporting a 17% increase in diamond drilling to 20,814 meters. Strategy in late 2025 focused on adapting mining sequences to ore characteristics in the lower mine levels, utilizing cut and fill methods to optimize extraction.
Looking ahead to 2026, Jaguar targets the restart of the Paciência mining complex, specifically the Santa Isabel mine. This complex has been on care and maintenance since 2012. Its rehabilitation is key to returning the company to historical production levels of 100,000 ounces per year. The bullish thesis for Jaguar is predicated on the mean reversion of its production profile. With Turmalina resuming in Q1 2026, the company will transition from a high-cost single-mine operator to a diversified dual-mine producer in the heart of the gold bull market. The participation of Eric Sprott and the aggressive 2026-2030 exploration plan suggest that Jaguar is undervalued relative to its in-situ resources.
If the company can prove the deep extensions at Pilar and bring Turmalina back to historical production levels, the stock could see a significant re-rating toward 1.0 times PA/NAV, representing over 40% upside from current levels. The bearish view centers on the inherent risks of small-scale underground mining in Brazil. The 2024 Satinoco incident highlighted the fragility of Jaguar's legacy infrastructure. Any further environmental or geotechnical setbacks would likely be fatal for the company's current capital structure. Furthermore, with an AISC currently exceeding $2,000 per ounce, Jaguar has zero margin for error if gold prices were to experience a significant correction. As a microcap player, it also faces a higher cost of capital and lower liquidity than its mid-tier peers.
Aura Minerals, the multi-jurisdictional growth engine. Aura Minerals delivered record-breaking results in 2025, underpinned by aggressive expansion. Preliminary Q4 2025 production reached 82,067 GEO, a 23% increase year-over-year. For the full year, the company produced 280,414 GEO, achieving the upper half of its public guidance of 266,000 to 300,000 GEO. The Borborema mine in Brazil reached commercial production in September 2025, on time and on budget. In Q4 2025, production jumped 54% compared to the prior quarter, reaching 15,777 GEO at an average grade of 1.42 grams per ton and a 91.7% recovery rate. Borborema is expected to be one of Aura's lowest cash cost operations. In late 2025, Aura acquired the Mineración Serra Grande mine from AngloGold Ashanti for $76 million, adding 80,000 ounces of annual production capacity. MSG's integration is a critical growth driver for 2026. Its December 2025 production already contributed 4,761 GEO to the record Q4 results. Aura plans to apply its turnaround expertise to improve cash costs and extend the mine life, leveraging measured and indicated resources of 1.08 million ounces.
The Era Dorada project, formerly Cerro Blanco, represents Aura's next major milestone. In January 2026, Aura received the final construction license and commenced early works, shifting exclusively to underground operations to minimize environmental impacts. According to the Era Dorada feasibility study, based on $4,200 spot gold, the after-tax net present value is estimated at US $2.17 billion. The after-tax internal rate of return is projected at 68%. Initial capital expenditure is approximately US $382 million. Average annual production for the first 4 years is expected to be 111,000 GEO. The life of mine is estimated at 16.8 years, supported by 1.75 million GEO in proven and probable reserves. The bull case for Aura is that it represents the most balanced investment in the sector, combining double-digit production growth with a sustainable dividend yield. The successful integration of Borborema and the acquisition of MSG provide a clear path to 600,000 GEO production. The Nasdaq listing has effectively re-rated the stock by providing access to U.S. institutional growth funds. With Era Dorada expected to be one of the highest margin projects in the Americas, Aura is positioned to generate record free cash flow in 2026 and 2027.
Aura's bearish case is rooted in its heavy exposure to complex Latin American jurisdictions. Aranzanzu in Mexico and Mendoza in Honduras have historically faced social and regulatory headwinds. Additionally, despite record production, the company reported a net loss in 2025, suggesting that non-cash items and high corporate overhead are consuming a significant portion of operating cash flow. If AISC continues to rise due to regional labor inflation in Mexico or Brazil, Aura's dividend may become unsustainable, leading to a valuation compression. The financial profiles of Jaguar and Aura reflect their differing scales. Jaguar has prioritized liquidity preservation, while Aura has leveraged its Nasdaq listing for expansion. Jaguar reported a net cash position of $60.3 million as of December 31, 2025, up from $46.3 million at the start of the year, driven by high realized gold prices averaging $4,170 per ounce in Q4. In October 2025, the company raised CAD $28 million in a private placement to fund exploration and the Santa Isabel restart. For Q3 2025, Jaguar reported revenue of $34 million and an all-in sustaining cost of $2,063 per ounce. Aura's financial position was transformed by its 2025 Nasdaq IPO, which raised $200.1 million in net proceeds. This capital reduced net debt by 77%, resulting in a 0.15 times net debt by EBITDA ratio. Adjusted EBITDA reached a record $152 million in Q3 2025. Aura maintains a dividend policy, paying out 20% of adjusted EBITDA minus sustaining and exploration capex.
Valuation. A comparative evaluation of these two companies reveals a spectrum of risk and reward, largely defined by their jurisdictional exposure and cost structures. As of early 2026, Aura Minerals trades at the most attractive valuation on a P to NAV basis when considering its dividend yield. Aura's P to NAV of 1.05x reflects the market's confidence in its multi-asset strategy and its successful deleveraging via the Nasdaq listing. Jaguar Mining remains the value play at 0.70x P to NAV. The lower multiple is a direct result of the 2025 Tourmalina suspension and the company's smaller scale. For investors, Jaguar represents a high beta play on a successful operational turnaround in Brazil. All-in sustaining costs and margin protection. Cost discipline is the primary determinant of share price performance in the 2026 inflationary environment. Aura Minerals has successfully managed its AISC, which stood at $1,396 per GEO in Q3 2025, significantly below the industry average. The addition of the Borborema and Era Dorada projects, both of which are expected to have AISCs near or below $1,100, should keep Aura's consolidated costs low. Jaguar Mining currently has the most precarious cost position, with an AISC of $2,063 in Q3 25. The successful restart of Tourmalina in 2026 is critical to bringing this figure down to a sustainable level of approximately $1,600 per ounce, allowing the company to fully leverage its high-grade pilar ore.
Risk assessment. Jurisdictional and operational risks. Jaguar Mining. Primary risk is concentrated in Brazil's Minas Gerais state. Regulatory clearance for tailings management is extremely stringent, and timing for NEA clearance remains a key uncertainty for the Tourmalina restart. Operationally, the company must prove the long-term safety of its new dry stacking protocols. Aura Minerals faces complexity across multiple jurisdictions. Honduras has shown anti-mining sentiment affecting the San Andres mine. In Guatemala, the Era Dorada project faces scrutiny regarding transboundary water impacts near the El Salvador border. Operationally, the company must successfully integrate MSG and maintain heap leach capacity at Minosa to sustain its life of mine. Financial. Jaguar Mining. Financial risk is tied to single-asset reliance during the Tourmalina suspension. The company must maintain its social license through transparent settlement of environmental fines and community compensation following the Satinoco incident.
Aura Minerals' financial risk is tied to high capital intensity, with development of Era Dorada and Matupá requiring significant annual capex. The company must also address cyanide management non-compliance in Honduras and maintain community dialogue in Guatemala to ensure project continuity. Conclusion. The comparative analysis of Jaguar Mining and Aura Minerals highlights a clear trade-off between turnaround potential and aggressive growth. Jaguar Mining offers operational alpha for investors seeking a deep value turnaround with high leverage to the gold price and a fortress balance sheet. Its success hinges on the completion of its 5-stage resumption plan. Aura Minerals offers strategic alpha for those seeking a diversified, high-growth producer with a consistent dividend yield. However, this growth comes with higher jurisdictional complexity and capital intensity.